Call the meeting to order. Call for a motion to approve the agenda.
So move, David.
Seconder,
Second, David.
and move to second. Question? All in favor?
Aye.
Alright,
An agenda. Conflict of interest, if any? None? So we'll move to the staff report, post-closure review, third quarter, it calls fairs and Aaron K. Langton.
Thank you, Mr. Chair. So I have taken over this reporting from Dawn. And I will be honest with you, this is not my area of expertise, so I'm gonna stick with the facts and I'm gonna let Colin talk about the market, as that is his area of expertise. So at the end of September, we were in compliance with our allocation mix. 2% of our investments were in cash and cash equivalents, 21% were in fixed income, and 77% were in equities. We started the year off with a market value of investments of 6.4 million. At the end of September, that's grown to 6.997 million for growth of about 582,000. So our market value has increased significantly. It's about percentage growth of 9.1%, which is excellent and well above our required obligation of 4.84% to meet our post-closure obligations when the landfill closes. So with that, I will turn it over to Colin. The market analysis in this report is his, and he'll provide more information on that. Colin?
Thanks, Mary Kay. I dressed up for you guys and everything, but my cameras have been giving me trouble today, so I hope you can hear me okay. Appreciate that. So as Mary Kay said, markets have been favorable, which results in the post-closure fund benefiting from the exposure to equities that we have, which is about 3/4 of the funds exposed to markets. The breakdown of that is about 40% in the US and 40% in Canada, remainder in Europe, Middle East, Asia. Relevance to that is, the headlines that we see on a daily basis, if not more, for those of us, living in this world. Because, the US markets fluctuate at the whim of someone controlling a Twitter account or anything like that. So, when we think about where we're getting the returns, it's important to know that we're not 100% in the US or 100% anywhere else for that matter. But that we've created a portfolio that's well diversified and can ride the turmoil that happens. Because when we ride that turmoil, we benefit. And as we've seen this year and years past for that matter, there was not terribly long ago in April, what we called Liberation Day, or I say we called, it was called Liberation Day by many. And markets had, a few days, if not weeks, of really tumultuous times. And the portfolio that the Service Commission is invested in, or the post-closure fund is invested in, is diversified in a way that we didn't see, the top come off. We were down on the month 4 or 5% back in April on the year, and today year to date being up over 9%. There's a significant swing, but we never saw a moment where we panicked and wanted to run for the hills, because we had some diversification into other markets outside of the US, as well as a small bond allocation that gives us, or fixed income allocation that gives us a little more stability when markets move that way. So we look at what the outlook is in the future. We never try to trade on week by week headlines. What we look at is a portfolio that can kind of weather the longer term. And then, the Service Commission's timeline on this fund being decades, we look to buy, a nice portfolio of quality companies that, over the long term will have positive growth. So when we think about what that means and, how do we find that, ultimately looking for solid balance sheets, industries that, have some durability in sort of all aspects of what goes on. And in doing so, we will see some exposure to tariff-related turmoil that, we continue to, but we want to be in a portfolio that can weather that. The short-term outlook, right now, or short, medium term, definitely inflation and employment numbers, especially out of the US, is very top of mind. There is, some stability in inflation, but that doesn't mean that it's not higher than what we would, or what the economists and the Fed, for that matter, would like to see. Given the reluctance in the US for cuts, there is more room and we expect to see more. Interested to see late next week what will happen. But in an interest rate, in a lowering interest rate environment, it's positive for markets in the long term. So that's sort of one plus for the market right now and why we're comfortable with sort of the outlook. The second being economic output. There's been revisions in an upward trend, expecting positive growth in the global economy output, given a number of things. One, and I guess largely forefront, is the impact that AI will have on company profitability and efficiency, for that matter. So that's sort of the other piece to why we expect a continued trend, maybe not straight up by any means, but in a positive direction. And then the last piece that's sort of helping ballast markets right now, trade activity is not quite as bad as we had kind of once expected. Tariffs seem to kind of create the headlines back in April. However, as we see more and more deals be met, it's still not as impactful as once thought, given sort of the revisions and changing of minds being changed over time on what those tariffs look like. So, those sort of are the three key pieces that we're looking at right now. Expect markets, not to run in a straight upward direction, but in a, over, up and to the right is what we say, in a positive way. So that's sort of my commentary. Wondering, I can open up for questions if anyone has any questions, comments, concerns, or needs at the moment.
Right. Thank you, Colin.
Sure.
And Mary Kay. Any questions? Okay. Well, thank you very much. I guess we can move on to our third quarter operating plans.
Appreciate it. Thank you, guys.
Yeah. All right, so I'm going to start with the balance sheet. This is the balance sheet for our assets and liabilities at September 30th. You will notice cash was down a little bit and accounts receivable were up. I think that's partly to do with collection slowed with regards to the mail strike that was going on. We are seeing some of those payments come in October, so that's good news. And we've really focused on collecting some of our past dues, which aren't significant, but we're always trying to make sure that we're collecting on them. And we have had some of those come in, so had some success there. Our total current assets at the end of September were 5.7 million. Our non-current assets, which consist of our various funds, as well as our capital assets and our asset retirement obligation investments, which Colin just talked about, were 34.4 million for total assets of 40.2 million. We had current liabilities, which is our payables and deferred revenue, of 3 million. Long-term liabilities, which includes our debentures of 4.4 million, those totaled 13 million. And then our equity was 24 million, which rounds out the liabilities and equity to 40 million. Moving on to the statement of income. So this is broken down by fund. So the first fund that you see in front of you is our Cooperative and Regional Planning Services Fund. To the end of September, if you look at the actual year-to-date column, which is the second from the right, you'll see we had a surplus of $68,505 for the first 3 quarters of the year. That's up $59,000 from what we had expected from the budget. What's driving that is lower administration costs. So we do have some costs that are coming in the fourth quarter. They haven't yet been billed yet. So some of that will be eaten up, but we are expecting to have a healthy surplus in regional planning. You'll notice both our other regional planning revenue and our admin expenses are over budget. That relates to the pool funding. So the pool funding comes in as revenue and it exactly matches the expense because it is covered with that funding. Our local planning services to the end of September had a surplus of 157,000. That's 116,000 higher than what we had budgeted. We did receive a significant amount of additional revenue with regard to our regional services support funding. So that's about 91,000 higher than what was budgeted. And our other planning revenue is 10,000 higher than what was budgeted. We did see a slight overage in our operating expenses of about 19,000 for the year to date. That relates to professional fees, specifically with regard to rural plans that are being performed by engineering firms. But we did see some savings with salaries and benefits with some vacant positions. They've now been filled, but we did have some savings throughout the year that offset some of those professional fees. Capital expenditures were pretty close to budget. Planning advisory services were a little bit under budget. So overall, our expenses for local planning were under budget by about 15,000. So that's what's leading to the surplus there. On the next page, you'll see solid waste services. So to the end of September, we had a surplus of 1,260,000. It's about 267,000 higher than what we had budgeted. Almost all of that is driven by additional revenue. So if you go, you'll see landfill revenue of 7 million to the end of September. It's about 105,000 higher than what we had budgeted for. It's interesting because our garbage tonnage is actually down for the first 9 months by about $90,000. So we are seeing kind of a decrease in what we see from previous years with regard to tonnage. However, our construction and demolition tonnage is up. So it's up by about $90,000. So that more than offsets it. But it's an interesting trend that we'll have to follow. And then what's contributing to that actual favorable variance is our asbestos revenue is up about 100,000 from what we budgeted. And that tends to fluctuate just depending on what kind of projects are happening in our region. The other landfill revenue is up about 55,000 from budget. That relates to our rental amounts that we get per ton for the soil remediation that comes across our scales. On the expense side of things, we did have some savings in operating expenses. Our salaries and benefits are down, our equipment costs are down, but you'll see that's being offset by capital expenditures, which were higher than what we had budgeted. And that relates to the gas collection project that we are doing at the landfill. Some of those costs were budgeted under operating for landfill gas maintenance, so there's an offset there. But yeah, the gas collection was the big project for 2025. We have some savings in debt servicing because our 2024 debenture was less than what we had budgeted when the 2024 budget was created. So overall, our expenses are pretty close to budget. We're about 25,000 favorable variance there. On the next page, you'll see our power generation facility. So we have a surplus to the end of September of 404,000, which is great. However, we have had some challenges with regard to the engines. They've been down for a couple months. They are back up and running now. They were up and running in September, so that was good news. But that's why you're seeing the unfavorable variance of 201,000 there. Our expenses are slightly over what we had budgeted, about 30,000 over for a total of 813,000. And we did have to purchase a gas analyzer. So that's what you're seeing under the capital expenditure. And we're in the process of purchasing a transformer, which is going to help the engines. I'm going to let Brett maybe just talk a little bit about what's going on at power generation.
Sure.
He's the expert there.
Thanks, very good. So we did have we had an issue with our transformer. There's quite we do routine inspections on that. We noticed a buildup of, I believe it's acetylene gas within the unit, within the oil. And that's an indicator that it's time to you've got an issue with your transformer. It needs to be swapped out before it explodes. So transformers aren't easy to source. We did a pretty comprehensive review on the options. We did eventually order a unit from Taiwan. There's a 42-week lead time on it. And with the help of a very experienced electrical engineer, I think we've got a management plan that'll keep us up and running at capacity, high output for that 42-week turnaround period. So yeah, we're optimistic. We're going to do routine monitoring. Things may change, but we're confident with the oil changes, we should be able to stay operational in the interim.
Right, so overall power generation, it's down about 231,000 from the surplus that we were projecting. Annually, we were projecting a surplus of 692,000. We're not going to be anywhere near there. I'm hopeful we'll be within a couple 100,000 of surplus. So it's still making money, but not the amount that we had anticipated for 2025 because of that issue. Regional tourism promotion. We have surplus of 22,000 to the end of September. You can see we have a little bit extra money that came in from regional services support funding. And then we have some savings on our operating expenses of 17,000. So that's what's leading to the surplus with regard to that. On economic development, there's a surplus again of 22,000. We had additional funding for regional services support funding, as well as our workforce labor force, which funds specific expenses. So you'll see the overage and expenses is covered by that additional funding. Community development at the bottom has a surplus of 109,000. Overall, we did have additional funding for regional services support funds, as well as the other funding that covers grants that are issued from ESIC as well as resiliency. So you'll see that the grants are covered with regard to that other funding. We are under on our operating expenses by about 60,000, but there are a lot of events and things that are coming up in the fourth quarter of 2025. So we anticipate that will probably decrease as we go on in the year. On the next page is regional transportation services. So we had a surplus to the end of September of 32,000. You can see that other funding is up about 73,000 from what was budgeted. That's our transportation study, which we got specific funding with regard to. That's also what's contributing to the overage and operating expenses, but overall a positive variance for regional transportation. Public safety, again, we have a surplus of 14,000. Both revenue is up for our regional services support funding. It's about 3,000 higher than what was originally budgeted. And then our expenses are running under. We do have a forum coming up in Q4, so we will expect some expenses to come through in there. And then the last fund is our Sport, Recreation and Cultural Infrastructure Fund. That had a surplus at the end of September of 51,608. Contributing to that is additional funding, which we received with regard to asset mapping. And then our expenses are running under budget by about 31,000. So overall, our consolidated surplus is 2,142,000 for the first 3 quarters. My expectation is this will decrease in Q4 as many of our 2025 projects are wrapped up. But I do expect 2025, we are going to finish with healthy surpluses in all of our funds. Any questions there?
I think. Sure. Oh, pardon? Okay. No, yes.
Any
I'm
questions?
fine.
Okay. No questions? Right. If there are no questions, we'll move on to the reserve fund policy.
Great. So this is something that we are revisiting. You'll recall back in May, we did present this to the Finance Committee. And at that point, it was agreed that we would forward this on to the board for information purposes. So that they would have that information for budget season. But it also allowed us not to have to rush through and approve something that hasn't been significantly vetted. So now the budget season is almost over. We vote on that Monday. We're back at the reserve fund policy. So we're bringing this information back to you. This is an abbreviated version of the report that you would have seen back in May. I don't want to rehash everything, but I do want to restate what's really critical and important with regard to the reserve policy. And I do feel like the reserve policy is one of the most important things that Finance Committee can be involved in. It supports the long-term planning and sustainability of the commission. It reduces the risk of service disruptions should unexpected events occur. And ultimately, it promotes stable and predictable fee structure, which is what you want as board members, your community want, and what staff wants as well. So the new policy that you've all seen It builds upon the commission's commitment to strong financial and fiscal responsibility. And it's guided by a comprehensive review of our capital assets, especially in the solid waste, so that we're planning for our current and future needs. And it's broader in scope. Our previous policy was a one pager. This provides more structure than what we've previously had in place. So this is a summary of the operating reserves and what we are targeting in that reserve fund policy. So as you know, each of our service line has its own fund. And so each has to have its own operating fund as well. Now, these are targets and they're slightly different than what was previously proposed in May. If you look at the draft debt or reserve fund policy, you'll notice that there are some changes. So some numbers are scratched out and some are new. These latest numbers are based on the 2026 budget, which is the most recent numbers that we have available. So we wanted to make sure we were using those. So I did track changes so you could see exactly what's changed since May up until now. So you can see those in the report, and the updated numbers are on this slide in front of you. And so what we're targeting for operating reserves, which could only be used for operating expenses. So for cooperative and regional planning, that would be based on 10% of revenue. The proposed target would be 30,000. We've already fully funded that. There's 35,000 currently in that reserve fund. Our local planning services, the proposed target would be based on 10% of revenue as well. That would be 255,000. And currently we're about 64% funded there. For solid waste services, the proposed target would be 10% of revenue, and that's 1,150,000. We're about 49% funded. For electricity generation facility, that's based on 10% of revenue, and that would be 110,000. We're about 46% funded. For tourism promotion, that's 5% of revenue. And that's 84,000. There's currently no established reserve fund for tourism promotion or economic development. Our target for economic development would be 5% of revenue of 124,000. For community development, the target is 10%, and that's 32,000, and we're 79% funded already. For regional transportation, that would be 15% of revenue or 22,000, and we are currently overfunded because we had some expense savings the past couple of years that we rolled into the reserve fund. Our public safety committee, based on 15% of revenue, that target would be 10,000. And then for sport recreation, the target would be 10% for 15,000. So the reason we chose those targets, it's really based on about 1 month's operating expenses. So if something were to go wrong, we have 1 month's worth of operating expenses that are set aside that we could, with the board's approval, use for those operating needs. Any questions? I might just pause there so we can talk about operating reserves before we get into the capital.
Any questions? I have a couple.
Director Fox.
Director Fox. Director Fox.
Yeah, I know there's some restrictions on operating operating reserves with municipalities. I believe it's 5% of expenditures from the previous fiscal year. Do those same restrictions exist here?
That's a great question, and there definitely was restrictions, but I know with the changes to the Regional Service Delivery Act, they did change those. So before I answer that question, I would like to confirm that these are well within what it previously was, but I think there's been some changes that I need to look up so I can answer your question appropriately.
Okay, I guess I just raise it for that reason, is if we're anticipating or thinking about moving money into these reserves, that we're not doing it outside of what's legislated. And I guess the question becomes then is where we are, all our communities are members of the of the Regional Service Commission, and we're bound by those limitations or those restrictions. Does that carry forward in our responsibility as directors of the Regional Service Commission? Guess that's the question that I would be concerned about or thinking about, is what are these restrictions and how far do they carry forward?
Yeah, so the Regional Service Commission would be governed by the Regional Service Delivery Act, and I
Right.
will confirm with you what those limits are, because they have changed.
Any other questions?
And and sorry, I just want to jump in, and Mr. Chair, I apologize for jumping in there, but I guess that may not necessarily affect the target of the reserve, but it might affect how much you put in any given year.
I believe in our case, it's the 5%'s the 5%, that's it. Now, in some communities, they're making, we are in our community making the decision to move the operating reserve into the budget, I guess I would say, differently, so that we're going to do that with one motion to make it all available at the beginning of the year. And in this paragraph here, we're talking about any withdrawal from the reserve fund will require board approval through a formal resolution by December 31st. So I think a little bit of an explanation about how that would work.
Yeah, sure. So any transfer to or from a reserve fund, as you know, has to be done by board resolution. You can do that at any time during the year, but you cannot go into the next year and then make. So it says December 31st because on January 1st, you cannot go back to 2025 and make a motion. But anytime through the year, yes, you're absolutely able to make that motion.
So is the expectation that each expenditure out of the operating reserve will be approved, or that how does that money get spent? I guess that's.
Typically, what we've done in the past is we've brought a motion at the end of the year. I can speak specifically to solid waste because that's the only one we've really had to take money out of before, and we would bring a total. So it would be to take 200,000 out of the operating reserve fund and transfer to the operating fund, and we would provide a breakdown as to why we were taking that money out. There was an unexpected disturbance or something went down and we needed that money in order to balance the budget before the end of the year.
Okay. Any other questions? Well, we can move on to general discussion and direction to staff.
Got a few more.
Oh, you have, excuse me, I'm not, I'm trying to follow along, but missing the point.
So no worries. I just paused there because that was the operating reserves, and now we're gonna get into the real
one.
the real one, yeah. So the next reserve fund, so we have to have separate reserve funds for capital, and those can only be used for capital replacement or new pieces of equipment, anything that's capital in nature. And we currently have 3 funds that actually have capital assets of any nature. Those would be local planning, that's relatively small. Their equipment would consist of IT as well as office equipment. The big one is the solid waste services, which is very capital intensive. And then power generation as well. So for our local planning services, our target under the policy is 15,000. We currently have 8,300 in a capital reserve fund. For solid waste services, our new proposed target would be 9.6 million. The current balance in there is 3.6 million. And then for power generation, originally in this presentation, we talked of 1.5 million. That was the cost of replacing the engines of the block swaps when we did it in 2022 and 2023. Those costs continue to increase, obviously, with inflation. So we felt it was wise, and I think I touched on this during the budget process, we were going to revise that target. So we've revised that target to 2.2 million, just to make sure that we do have that money set aside. The block swaps are targeted probably for 2031, 2032. So that would be the time frame for having that 2.2 million in the power generation capital reserve. And currently there's 891,000 in that fund. So why do we need 9.6 million in our solid waste capital reserve? We've talked about this before, but I think it bears repeating. We do have critical infrastructure at the solid waste facility that if it does go down, we need to be able to act quickly in order to take action. And if we don't have money set aside to be able to act quickly, it's 2 to 3 months to go to the municipal capital borrowing board to get approval. And that just does not work. We also know that our future cell development costs are going to be significant. So we have been fortunate with the EIA that was approved back in 2018. Our current cell construction is piggybacking on those existing cells, which means that the cell costs that we have to bear currently are very low, relatively speaking. So it's about anywhere between 100 and 250,000 per cell, depending on where it's developed. Versus when we get into the 2030s, the estimated costs are between 1.2 million and $3 million per cell because of the excavation that is required. So over that 10-year period, it's about $10 million to build those cells that are going to be required in that time frame. The other thing that's coming on the agenda is in the early 2030s is there's some facility upgrades that are required. So we're a 40-year-old site. And as you can imagine, some of that infrastructure is aging and is going to require replacement at that time. So we're preparing for those costs as we know they're coming. So just so you know, historically, we have financed equipment purchases that are over 100,000. But in the early 2030s, because of these significant costs, we're not going to have capacity to borrow for 100% of these upgrades that are required and maintain our debt service ratio target of less than 15%, which is in our debt management policy. So that's why it's important for us to have funds set aside to be able to pay for a portion of these expenditures when they become realized, and then we can borrow for the remainder. So what that means in 2031, we know we have approximately 12.1 million, and this is just based on estimates today. These numbers will absolutely change. But we need to be in a position to fund approximately 50% of that $12 million costs in order to maintain our debt management policy, debt service ratio of 15%. So overall, we really have a 5-year window where those cell costs are so low, that allows us to prepare and have money set aside to plan and prevent future cost spikes. So we are trying to take preparation today that promotes the stable and predictable fees in the future. Based on our current projections, as we talked about during the budget, we can get to that $9.6 million that's needed in the capital reserve fund with $3 to $4 annual tipping fee increases for the next 5 years. And that should get us to the 9.6. If no action was taken and we just left things alone, you're probably looking when you get to that time frame of tipping fee increases of in excess of $40 per ton one time. And then that's going to set us up for a spiral in 2030 to just try to catch up. And it's going to go, instead of our stable and predictable fees, will be spiking, and it's important to plan today. I can't overemphasize that. So overall, we are in a solid financial position where we're starting from. We just want to build on where we are currently at. And it's important to note that our needs not immediate. We are planning for the future. Our goal would be to have fully funded reserve funds by the end of 2030. And that would allow us to continue on this path, stable and predictable fees. So in my report, there are 3 options that I've presented that the finance committee can choose. So we could recommend to the board that it adopt the draft operating capital reserve policy as presented. You could recommend to the board that it adopt another version of this policy, or you could choose not to proceed with the adoption of the policy at this time.
Questions? Well, what are the feelings around the recommendations?
Like Mary Kay says, it's easier to build it up over a number of years, to try to swallow that big pill all at once. So. Only makes good sense. It's what we do at home, when you're managing your own budget, you're putting away for, you need a new roof, well, let's try not to spend all at once.
Can I, yeah, I was wondering, like, I'm all for reserve and, you know, there is no surprise coming in 2030. We know that that's coming, so funding, won't be an issue to get in place, so. Is there going to be is this an exact number that, you know, that 9.3 million at that point in time, we will stop, that is the number we're looking for, or is, like, I'm a little bit confused as to how far we're gonna go with it. It seems like each and every year we increase tipping fees to get so we can add reserve and whatnot. And then we talk about when there's a break fix, well, we gotta do this and to add to it again. So I'm a little confused on it. I like the idea of a reserve, but I'm just not sure what the breakdown of break fix is, or emergency fix, because we can't wait, versus where we have to be in 2030.
Yeah, so the breakdown of 9.6. So we know in the early 2030s, we have a cell that's coming up of about 3.4 million. That leaves about 6.2 million. We know we have to be able to fund half of the Baylor building in order to maintain our debt service ratio. So that's about 4.5 million. That leaves about 1.7 for critical failure. So that's kind of our buffer if something were to go wrong. And 2031 is just kind of our goal right now. We still do have to roll that out and make significant changes when the original infrastructure is replaced in 2030. So this is kind of like a rolling forecast. 9.6 is our goal that we know we need within 5 years, but it's going to change again when we get 2 years closer, and it's just going to continue to evolve as we get better estimates.
And if I could add something to that, Mr. Chair, I mean, it's Director Nicklin is based on Class D estimates on capital replacement costs going to the end of the useful life of the landfill. So we're trying to factor in as much as we can and take a long view on it. The other factor that's obviously going to play into it are critical infrastructure failures along the way, things that are unplanned, and that'll impact the contribution rates.
Yeah, but it'll also, we can't predict the future. We don't know what's gonna come out in the next 5 years, whether there's new innovations for this or not, or cost savings or more expense.
Correct. It's based on the known knowns.
Okay.
Yeah, I don't know what you don't know.
Any other questions? I guess my only concern here is that it seems to be rather tight. I guess we'll know a little bit more next year and the year after, but it would seem that we're planning to be broke in 31. You know, almost, because $1 million, what was it, $1.6 million? It isn't much money in terms of the things that could go south in an organization over the next few years. So it would seem to me to be a pretty tight estimate this time, and maybe a little too tight, given the borrowing requirement. So if we were just going to be in a situation where we were saying, well, we wouldn't want to borrow more than that. That would be one thing. But if we get into a situation where the province says you can't borrow any more than that, then that's much different. Then we start to lose money because of the businesses that we're running basically aren't able to function as well as they should with the requirements. So I guess it's a good start from my point of view, but something that's going to have to be watched really carefully to make sure that we're not ending up basically without any reserve or that sort of thing in 2031. Any other comments, questions?
Could I just?
Yes.
Yeah, that's a great point. And we have been as conservative as possible because we understand that there are pressures on municipalities and we don't want to ask for the moon when when the estimates are still coming in. So it will have to be revised every year. The other thing that I do point out is the province's limit is 20%. So our 15% is a conservative estimate. So we do have a 5% buffer. Not that I would recommend
Yes.
going over that, but there is, should something come up that wasn't previously known. Director Fox.
Director Fox?
Yeah, I just want to kind of reiterate that, with respect to the capital reserves, I have no issue with preparing for the future. I guess, and I'll just reiterate that when it comes to operating reserves, I think for myself, I would prefer that we follow the same restrictive numbers that we're forced to comply with as municipalities.
Any other comments, questions? Okay. Now, we can move on to general discussion and direction for the staff. Any? Did you have any closing?
No, Mr. Chair, I want to thank Mary Kay and her team and Brett and the teams that have contributed into this. It's a lot of work going on. My first scan was when I was looking at my phone, was trying to find if there was a limit to the 5%, the same as municipalities, and I don't see one.
Change.
Yeah.
I think they changed that in the most recent.
I did a few quick searches there and couldn't find it within there unless it's, there might be a piece buried regulation. We'll have a serious look at that right away. But to that point, on the 5% and understanding, we've been, Mary Kay and the team, especially in the finance division, have been extremely conservative and frugal in terms of how we operate. In order to understand, there is a difference between the municipality and the commission. And with that, we're running a different type of organization. So I wouldn't want to be held, just to that and compliant to it. I think we have to be realistic. I think we have to be, have two kind of views on that. Keep to the municipal limit, but also is that even enough for down the road? We don't know what tomorrow will bring. I like being conservative myself in my estimations and our budgeting. We've shown that year over year, we're very frugal and we try to bring in the best budgets possible for the organization. But there's also something to be said for good planning and being prepared for what could come down the road. And if we benefit the communities down the road, Mr. Chair, then so be it. They reap the reward of good leadership today.
And I think it's important to note that it's moving towards those targets that we're talking about, not funding every one of those targets, funding them out of surpluses and benefits. So in our community, we're funding our surplus this year. We're not our surplus, our operating reserve, we're funding it purposely, so we will have the 5% built in total. We're not waiting for a surplus to come down the road and then move it in. It will take some creative movements to make that all work, but at the end of the year, things will get straightened out. So it's much different for us here at this table, because we're saying it would be nice if we had this much reserve down the road, and when we get surpluses, that's where we're going to put them. I think that's quite a difference between us and the municipalities. So. Any other comments, questions?
I'm pretty confident in our CFO and our team from what they've presented here, and I think it is a living document. What's cut out for us this year, it could be incrementally different next year and the next, and I think that's well understood to this board here. But we have to make an initial start and go, I think, with what's recommended by the team to start these reserves and just keep monitoring them closely.
Some direction, Mr. Chair.
So the direction I'm hearing here is that we would recommend the board adopt the operating and capital reserve policy as presented. With that's what I'm hearing. I'm hearing Director Fox caution us about understanding that, and but I haven't heard any other issue.
Mr. Chair, we'll take a deep dive into the legislation, the regulations, and convey that message, that information back to the stable.
Thank you.
Oh, Dr. Fox.
Director Fox.
Yeah, you're not gonna take too much of a dive in the legislation to find that there are no limitations on regional service commissions for operating reserves. I've already looked, and out of principle, I'd like to find us in a place where we live up to the same limitations as municipalities are required to, because I would rather use my money annually than put it in reserve somewhere else. And that's the pressure that we're under, is we're going to be severely pressured for budgets this year with the freezes on assessments. We've already been estimated that we're gonna get a $28,000 increase in our tax revenue this year. So that's the principle that I'm talking about. I already know that you don't have any limitations. I'm just saying it would be nice if we lived up to the same restrictions and limitations, so that we can, as municipalities, we can maximize the money that we use in our municipality and still do responsible things at the Regional Service Commission level. And I guess that's been my point. And I'll leave it at that.
Anything else?
Chair, I just have to say, and Director Fox, thank you for taking a look. I know you have your computer in front of you. I don't at this moment. But my AI search said that your information is correct, but I didn't want to AI. We were just all at the forum this morning, the Ignite Summit on AI. So while it's highly trustworthy, I don't consider it 100%. So anyway, thank you.
Okay. Are we ready? Motion to adjourn?
I so moved, David.
Second? Question? All in favor?
Aye.
We're down. Thank you all.
Thanks, everyone.